Welcome back, Focus Learners. Today on The Explainer, we're putting a tech giant through the ultimate test. We're taking Western Digital, ticker symbol WDC, and running it through what I like to call the investment guru gauntlet. Our goal? To see if its absolutely incredible recent run, which has been totally driven by this massive AI data supercycle, is mathematically justified when we look at it through the eyes of the greatest investors in history. Okay, let's dive into this because the narrative tension right now is just fantastic. On one side, you have this massive 727% rally over the last 12 months, totally fueled by incredible AI tailwinds and hyperscaler demand for data storage. But then, on the other side, we have a deeply overbought relative strength index, the RSI, sitting at an extreme 85.9. So is this a permanent structural breakout for the business, or is it just another cyclical bubble waiting to burst? Figuring out the difference here is absolutely crucial for anyone trying to navigate cyclical tech stocks in their own portfolio today. So here's our roadmap for the explainer. We'll start with a quick snapshot of Western Digital, then we'll run it through 4 analytical lenses: Warren Buffett's mode approach, Peter Lynch's growth perspective, Benjamin Graham's strict value check, and some modern DCF models, before bringing it all together in a final synthesis. Section 1. Western Digital Company Snapshot. Let's set the stage here, because the Western Digital of today has completely transformed from a struggling conglomerate into a highly focused data infrastructure giant. I mean, just look at these raw stats. At roughly $490 a share and a $168 billion market cap, this company is an absolute beast. By spinning off its flash division, SanDisk, WDC basically became a pure-play provider of high-capacity hard disk drives. And the numbers, they reflect a stunning turnaround. Debt to equity has collapsed to a pristine 0.16. Return on equity has surged to 33.1%. And their Q3 2026 revenue, it grew by an explosive 45.5% year over year. By shedding that volatile flash business, they've positioned themselves to capture the lion's share of the AI data cycle. Moving right along to Section 2, the Warren Buffett lens. Let's channel the Oracle of Omaha for a minute. For Buffett, the analysis is all about business quality, protective economic moats, honest management, and cold, hard owner earnings. And this brilliantly illustrates how WDC actually passes Buffett's qualitative tests with flying colors. It operates in a practical duopoly with Seagate, which is fiercely protected by the extreme physics of SMR and HAMR hard drive technologies. That's a massive barrier to entry. Plus, CEO Irving Tan exhibits great discipline, and honestly, that 0.16 debt-to-equity ratio is exactly the kind of conservative leverage Buffett loves to see. Earnings are recovering, with gross margins hitting almost software-like levels of 50.5%. Those high barriers to entry are actively protecting those sweet margins. But what about the actual financials? Think about this number, $978 million. That was Western Digital's Q3 free cash flow. A hardware manufacturer dropping nearly $1 billion in quarterly free cash flow represents the exact kind of owner earnings that Warren Buffett just adores. It proves the business generates real, highly usable cash. But, as we all know, Buffett also demands a strict margin of safety on the price itself, which we're going to test a bit later. Now, let's shift gears to Section 3, the Peter Lynch lens. Lynch looks at stocks a bit differently. He categorizes them by growth and momentum, and he pays very, very close attention to what insiders and institutions are doing behind the scenes. So if we classify WDC using Lynch's specific framework, it's a classic turnaround story that's rapidly morphing into a fast grower. The balance sheet is really strong, basically repairing itself quarter by quarter into a net cash position. And we're seeing massive institutional buying, right? This is partly driven by the stock's recent inclusion in the NASDAQ 100 index. However, Lynch would spot a glaring red flag here: recent insider selling. The CEO and COO recently unloaded $10.2 million in shares. That creates some real tension between the massive institutional demand we're seeing and the actual people running the company choosing to take some chips off the table. Now let's look at Lynch's absolute favorite valuation metric, the PEG ratio. We take the forward PE multiple, which sits right around 34 times, and we divide it by the projected EPS growth rate, which analysts at Ticker estimate to be roughly 34%. Well, 34 divided by 34 gives us a calculated PEG ratio of exactly 1.0. Traditionally, a PEG of 1.0 would trigger a strong Lynch buy. For him, that explosive growth perfectly justifies the high earnings multiple. So, from a growth at a reasonable price perspective, WDC looks incredibly attractive. But what happens when we strip away the whole growth narrative? Section 4. the Benjamin Graham lens. We are going to adopt a highly conservative, protective tone right now, introducing the ultimate value reality check to sort of ground all this AI hype. Running down Graham's defensive investor checklist, we honestly get a mixed bag. Adequate size, pass. Strong financial condition, pass, thanks for that incredibly low debt. Earning stability, pass again, they're recovering beautifully. Dividend record, yep, pass, they just hiked it to 15 cents. But when it comes to moderate valuation multiples, it completely fails. The price-to-sales ratio is a stretched 13.3 times, and for Graham's conservative blood, that is just way too hot. So the crucial point here is how this translates to his famous intrinsic value formula. We take the square root of 22.5 times earnings per share times book value per share. Using an annualized Q3 EPS of $10.88 and explicitly deriving an assumed book value per share of $32.87, and we had to do that because it was absent from the raw data, so we just backed into it using their 33.1% return on equity and EPS, we calculate a Graham intrinsic value of just $89.70. And that leaves us with a massively negative margin of safety. At the current $490 price tag, the stock is over 80% higher than Graham's calculated intrinsic value. The conclusion here is pretty simple, folks. The ultra-conservative Benjamin Graham would absolutely not touch this stock at current levels. No way. So Graham says no, but Lynch says yes. Let's move to Section 5, DCF and alternative models. We're transitioning away from historical heuristics to modern financial modeling to see if future cash flows can actually, mathematically, justify the current price. Just so we're all on the exact same page, let's quickly outline the mechanics of a discounted cash flow model. It involves three main steps: forecasting future free cash flows, calculating a terminal value for the business in perpetuity, and then discounting all of that future money back to its present value using the company's weighted average cost of capital. For WDC, that's estimated at 8.4%. So let's see what happens to WDC when we put this machinery to work. When we plug the numbers in using data from valueinvesting.io, it paints a pretty tough picture. Using that 8.4% WACC, a 5-year growth exit model gives a fair value of $203.95. A 10-year model pushes it slightly to $218.72. In either way you slice it, strict historical modeling shows a severe downside risk of over 55%. Based on pure cash flow discounting of their current trajectories, the stock is heavily overvalued. Let's move along and see how this builds when we bring in some more optimistic projections. Because if we compare that bearish historical DCF with highly bullish alternative models, the ones that price in aggressive, sustained AI spending, the dynamic totally shifts. Teeker's mid-case model, which assumes a 23% revenue compound annual growth rate, targets a massive $877. A stable dividend discount model points to $541, and the general street consensus target sits at $518. So if you truly believe the AI supercycle is permanent, these forward-looking models suggest there is definitely still room to run. All right, now for the main event. Section 6, Synthesis and Final Recommendation. It's time to bring all these contrasting numbers together to deliver a final, completely impartial verdict on Western Digital. Looking at our master valuation synthesis, we have a pretty extreme divergence. Warren Buffett loves the moat and the cash flow, but he'd likely hold and wait for a better margin of safety. Peter Lynch sees a peg of 1.0 and says, buy. Benjamin Graham looks at the $89.70 intrinsic value and says, sell. The base case DCF agrees with Graham, implying a sell. And yet, the forward-looking alternative growth models like Teeker absolutely scream buy. It's a perfect 50-50 split between value-focused reality checks and growth-focused momentum models. Blending all these insights together, we arrive at our final impartial verdict, which I think is incredibly useful for setting your own portfolio strategies. Look, WDC is fundamentally transformed. Its key strengths are undeniable: 50.5% margins, amazing pricing power in a duopoly, and the absolute tailwinds of the AI data supercycle. But the risks are equally stark: an extremely overbought RSI of 85.9, a historically brutal cyclical industry, and immense pressure to execute flawlessly on their 40-terabyte roadmap. Therefore, at $490, it's a fundamental hold. For value gurus, your buy trigger is a pullback below $300. But for growth investors, you're buying on continued earnings per share beats. Which leaves us with one final, profound question to ponder as we wrap up this explainer. Hard drives have literally always been a boom and bust business. But with every single AI prompt generating new data that needs to be stored somewhere forever, Will infinite AI data generation finally break the brutal laws of hardware cyclicality? Or will this time not actually be different, and the cycle will inevitably turn like it always has? Think about that, and keep learning.